We've got a guest here, and I want to bring him into the conversation. I want to get more insight into today's market action and what's next for investors, particularly in bank stocks. I want to introduce Charles Peabody, partner at Portales Partners. Great to have you with us, Charles. Thanks for joining us. So what do you make of this idea that people might be selling into the rallies? I noted in a couple of your reports that you think, at least for bank stocks, we've kind of hit that plateau for a while.
We do. Our call is that bank stocks put in a top between the mid-March announcements on dividend increases and share buyback programs and the robust first quarter earnings in mid-April. And there's about a 30% correction coming.
A 30% correction?
Well, is that S&P or is that just in bank stocks?
In bank stocks. But bank stocks historically have been leading indicators for the overall market. And a lot of the indicators I look at suggest that, the market on the S&P could go down to 1250, and it wouldn't shock me.
1250. This even after IBM says they're going to buy back more stock. They increase the dividend. And indeed, if you take a look at some of the earnings reports, let's say Apple right now, not so bad. This is actually besting Wall Street estimates.
Yeah, but you take a look at a stock like Bank of America, it's already down 20% from its high. And most of my money center and investment banks are down double digits from their recent highs. You look at industrial stocks like Caterpillar or Joy Global, and they're down. They made peaks in late February, early March. Copper, which is, the old trading adage is a good market top is made with a copper roof. Copper has not been able to make a new high for several months now. So the industrial and base metals are showing weakness that suggests there's a slowdown coming.
Now, speaking of copper, now Barclays has coming out with a report saying that in the second half of the year, they expect demand to really pick up, particularly from China, and growth there to get better, and saying to buy copper on dip. So how do you counter your more negative outlook for bank stocks with, say, more global positive data out of China?
Yeah, that's part of my global economic weakness theme is if you look at the ETF EEM, which is for emerging markets, you'll see that made a high back in, I think it was March. And hasn't been able to lift since. And emerging markets are starting to show, our investors in emerging markets are starting to show concerns because of the nationalization in Argentina. The tax increases they put on mergers in India, the capital restriction flows they put on Brazil. So it's getting dicey in these emerging markets, and we're starting to see outflows in the mutual funds. So
outflows in mutual funds from emerging markets.
Emerging markets.
And that's been the darling of the stock market for a while, hasn't it?
It has. And, and then you look at things like housing, and the home builder stocks can't get out of their way after Lennar made the high on March 27th. Lumber can't seem to get out of its own way. So there's signs that the weakness is increasing.
Well, if the weakness is increasing, isn't the Federal Reserve going to ride to the rescue with more quantitative easing or more programs in order to stimulate the economy? Isn't that what's going to give the boost to stocks?
I think they will, Pimm. And, Weidmann today said it's unlikely that we'll
He's the head of the Bundesbank,
yes,
right, in Germany.
In Germany.
Okay.
And unlikely we'll see a third LTRO. But I do think we'll see a QE3, but probably not until June, July. And it'll be a reactive to economic weakness. So we could have a pretty good correction between now and then.
And then what about China? You mentioned specifically weakness in emerging markets. I've been hearing from many firms like Societe Generale that there isn't going to be any interest rate cut, but perhaps lowering the reserve requirement ratios by another 50 basis points.
Yeah, at this point, I'm not a big bear on China because they have so many resources they can bring to bear to produce the economic growth that they want. After the election at the end of this year, I think the bets change.
What about high yield corporate debt? Because I noticed that a lot of people have been piling into those types of instruments because they say, you know what, I'm not going to lend my money to the U.S. government for 30 years and get 3.13%. I'm not going to lend it to 10 years and get under 2%. So go buy some of that great high yield paper out there. What do you think?
Well, again, if you look at the ETFs, JNK or HYG, which are proxies for the junk bond market, they have been rolling over for about 2 months now as well. We had a record amount of fixed income underwriting and trading in fixed income, which produced phenomenal results for the banks in the first quarter. And yet I see a debt widening spread starting to develop right now. So I think it doesn't continue.
And then staying with stocks just for a quick moment, if we do get a QE3, if we do get an LTRO number 3, what happens to the S&P? I mean, do we see new highs for the year, and is this then the time to buy if we get that correction to 1250?
Well, if we do have a severe correction going into that, we're going to get a knee-jerk bounce of some sort. But I don't think it's going to be enough to sustain the economy. I think we roll into a recession in 2013.
A recession in 2013?
Yes.
But you think that we don't go into a recession? Why in 2012? Because we got an election in November?
Yeah. And, they're going to pull out whatever they
can. You're so cynical, Charles.
I've been doing this for 30 years, Pimm. It gets you there.
And is it a pattern, that you see?
Oh, very much so. Now, this year is a little bit different because there is gridlock in Washington, and that may prevent, any kind of fiscal stimulus.
What about the stronger employment data that we have been seeing? Yes, last month's reading was soft, but it seems to always be soft around Easter, and then they sort of revise those initial jobless claims upward in April.
Yeah, I mean, employment is a lagging indicator. If you look at the leading coincident lagging indicators, employment's in the lagging indicator. If you look at the ECRI weekly leading indicator, it's actually starting to turn down again.
What about incomes? I'm always looking at whether people have extra money to spend because, there's this idea that there are stocks out there as a limited number of shares, and unless there's more money to buy those shares, it doesn't matter what happens to earnings or quantitative easing. If there's no more money to buy stock, the stock market doesn't go up.
And that's what you've been seeing. You've been seeing a rotation from group to group to group as this topping process has been developing in the first quarter. I mentioned the industrial stocks and the base metals. They've been very weak in the first quarter, but you started to see it in tech just recently and some other groups, so like financials.
And what about the consumer? Where's this going to leave them here, especially headed into an election year? I've been reading some notes also that says that we're seeing a drawdown in savings rather than income growth. Are you noticing a similar pattern?
We are. They are dipping into their savings to make the final sales as robust as they are. We're starting to see a re-leveraging of their balance sheets in certain product areas like auto loans, student loans. Even in credit cards, we're starting to see some revolving growth now. Obviously, in the real estate market, there's principal reduction going on. And that's one thing I want to mention that I don't think is in analyst models on banks. As you know, Pimm, we've experienced a lot of revenue headwinds in the last 2 years from the Durbin Amendment, from the Card Act, from Reg E. What we have going forward is going to be a reduction in revenues out of these mortgage portfolios because of the AG, the Attorney General settlement, because of change in accounting from home equity loans. And then I think later this year we're going to get a reduction in interchange fees for credit cards. So there's going to be a significant amount of revenue headwinds that I really don't believe analysts have in their earnings models at this point.
Well, that's one of the reasons, I guess, why you think that bank stocks could fall, 30% indeed.
As a starting point.